In this video, guys, we're going to look at what are the behavioral finance explanations of market anomalies. Stay tuned. Hey traders, warm welcome to you. Okay, so market anomalies are things that go against the efficient market hypothesis theory, which is that every investor is rational and they act with clarity and they make the logic decisions. Listen, I don't subscribe to that. From a short-term trader's perspective, we know that's not the right case. We know that that's not correct, guys, don't we? However, I am a believer that a lot of the time markets are almost efficient. They chug around, there's a few buyers, a few sellers, and there's no edge there. I think that it comes in spells. So we have spells of opportunity where there's inefficiencies, where there's anomalies, market anomalies, where there's something that presents us with a trading or investing opportunity. That does happen. And listen, we see this on a broad scale. Think of crashes and bear markets always overshoot to the downside before spiking back up aggressively, and we see this each day with things, news releases, etc. So the opportunities are there, and that's when we can capitalize, when we have these market anomalies, when we have things that are just not generally they're not explained by logic, if you like. And there's the opportunities. But if we look at a broader sense here, what are the behavioral finance explanations of market anomalies? So we have this conservatism, which is, and traders and investors for the same thing here, we're attached to old sets of beliefs. So if we believe something is a good company, for an example, we will continue to believe that even if we have plenty of evidence there that shows us it's not. And this is where it goes against that everyone's just trading or investing from a logical, clear perspective. If we have this conservatism where we actually believe that something is from previous and we can't change the belief, there's studies as well, aren't there, with political parties and stuff, why it's so hard to get someone to change if they've just been voting one way for a long period of time. And so it's the same with stocks, right? If you believe that, ABC stock is the best stock ever, you've had it for a long time, you've loved the company as a child, and you've kind of been to their restaurants or whatever it may be, you're going to still believe that. It's going to take a lot to swing you the other way. So there's some inefficiency there. So you've got to watch out for that one from your perspective, and also look at it potentially for an opportunity, a trading opportunity. The other one is overconfidence. Guys, I think most traders have succumbed to this one. We think we're geniuses from time to time. We overestimate our abilities. And I would say that's probably anyone who's overtrading. If you're overtrading or overinvesting or churning, you believe that you can just take money from there and take money from there, and there's loads of opportunities and you're going to be able to make money in all of them. In reality, it isn't the case, is it? And it's often the case with investors as well. They may allocate capital to an investment, and rather than just sticking with it that's working and it's chugging along nicely, where they get some dividends off it, it's growing, the stock has become more valuable, they might come out of that and think they can find something better elsewhere. It's overestimating their ability to perform. And we've got another way of biased self-attribution. So acknowledging the events that confirm the existing beliefs. So example of this could be, hey, you're long a stock, and you go into a forum, you go into Twitter, you go into StockTwits, you go into anywhere like that, and you're just looking at bullish arguments for staying along that stock. You're not looking at bearish arguments, you're not looking at both of them and taking an objective view. You're just cementing your value. And actually, if we stay on the political theme, we've never gone into politics at all on this channel, but it's a good example, is that people generally on social media will follow people who have the same leaning bias with them. So if you lean to the left, you tend to follow lots of people that confirm your bias, and you won't listen to anyone from the right's argument or anything. And then vice versa, if you're right leaning, you'll tend to surround your followers and you'll follow and you'll subscribe to and you'll like all the channels and people and accounts that kind of reinforce your beliefs. And there was a study that this kind of tends to spread the left and the right against each other. So similar with stocks, right? We have a situation where you just kind of reinforce your beliefs. You're only acknowledging events that confirm existing beliefs. And I did say events here and not information, and I think it's both. The events would be, okay, some good news comes out, you kind of really, hey, that's a great thing for the stock, it's going to do well. Bad news comes out, you just shrug your shoulders and say, well, it doesn't matter, it's irrelevant. You just dismiss stuff that goes against your position. Same with events and news. Okay, we've got attention bias. So this is when, companies that are in the news a lot or in the media a lot tend to get a lot more, you tend to be a lot more biased towards those than the smaller stuff that's not in the media and the news. So that's why we see, you know, when some of the financial channels are talking about certain stocks a lot, that's going to bring in a lot of money. And we've seen this before with some of the like famous talking heads that will talk specifically back at the stock, and it will boost the value of the stock. That's a short-term effect from people seeing it and going out and buying it and creating a short-term supply-demand imbalance. But even generally, if something stock or companies in the news an awful lot, positive or negative, it can work both ways. You know, something negative about you know, disease outbreak in a restaurant, perhaps that's going to affect the stock. It's going to affect people wanting to sell the stock, short the stock. Similarly, if you know some great news coming out about a car manufacturer or whatever, people are going to keep buying the stock and it's going to keep pushing up. So those are some of the explanations of market anomalies. Lots of market anomalies out there, but there's a few to think about, giving us opportunities as traders and investors, but also something we have to be cautious about ourselves. We don't fall into these traps. All right, guys, take care. See you in the next one. Goodbye.